Welcome back. My name's Chris Gosselin from Australian Fund Monitors. This morning we're talking to Rodney Brott, fund manager from DS Capital. Rodney and his partner James run the DS Capital Growth Fund. It's got a 10-year track record, during which time it's made an average of 14.5% over that time. Rodney, welcome to Fund Monitors.
Thanks very much for having me, Chris. Good to see you again.
Nice to see you again. So what's been happening? We've just finished the end of reporting season. Can we start with that? There's a lot going on, but reporting season, how did you find that?
Sure. Interestingly, reporting season was actually quite good. Many companies reported strong results, and fortunately for us, from our portfolio's point of view, the companies produced results as good, if not better, than what we were expecting, which is very important because it shows the underlying businesses are performing well and the Australian economy seems to be performing well. Unfortunately, none of that was really interesting to investors over the last month or so, given investors' focus on the macroeconomic events such as potential for runaway inflation and what that would do to interest rates, and also the geopolitical tensions that have manifested themselves with a very unwelcome war in Ukraine.
So is it really a question that the macro is completely governing things at the moment? And obviously there are individual companies that are being affected from that more than others, but the macro has taken over. Is that correct?
I think that's absolutely correct. There are investors that are exiting stocks, exiting the asset class as people look for safe havens. Mostly that's been in gold and energy over the last little while, which are areas that we traditionally don't invest in, and that's left a lot of businesses that have reported strong results with share prices substantially below where they were in late December of last year.
So investors are really faced with the issue of saying, well, do I hold on because I'm a long-term investor, which is sensible, or do I sell? Do I run for the hills and take cover? Or do I take this as an opportunity? And it would seem to me to be three different alternative approaches. How do you look at it?
Yeah. Well, look, it's always very, very difficult to keep a level head in these times of crises. But traditionally, for those investors that are patient enough to look through the noise and look through the volatility, there will be opportunities. The question is, over what period of time will those opportunities reveal themselves? We tend to take a longer term view. When we invest in businesses, we would like to hold them 3, 4, 5 years, because good businesses are hard to find. Now, at the moment, there's many reasons for investors to be concerned, and particularly those reasons have, almost, in the case of wars, existential risks. But ultimately, you can't build an investment strategy around, existential risk that could threaten the entire world, because if the worst case scenario develops, then ultimately it's not going to matter what's in your portfolio. We take a view that we can't add enormous value to an analysis of geopolitical events. Therefore, we are concerned about them. We take them on board, particularly when we're determining when to buy things, etc. But from our perspective, we feel we add the most value by looking at businesses from the ground up, trying to understand how those businesses operate, the operating environment, the people running those businesses, and most importantly, how they will grow over time. And they're the sorts of businesses that are attractive to us, and the share prices of those businesses, or some of those businesses, have come back a lot because of those major macroeconomic influences, and some of them will be attractive.
So is it a question of sort of steady as she goes, or do you take some risk off the table in certain areas to redeploy elsewhere?
Look, we've got currently quite healthy cash levels. We had taken some risk off the table on the basis that we haven't aggressively replaced things that we either had been selling or were selling, and we haven't deployed a huge amount of our cash reserves just at this stage. There will be plenty of opportunities. We have no skill or ability to pick the bottom of markets that are driven by fear and emotion rather than fundamentals. So, at a certain point in time, and we've already started with a very small amount, we'll deploy some of that cash on the basis that fundamentals will ultimately be focused on again. And once the noise passes, we feel that prices will start to move back towards where the fundamental value of those businesses are.
So how would you describe that? If I can try and describe that sort of cautious opportunism, is that fair or not?
Yeah, look, I like to think that we're always cautious, and I'd like to think that we always take our opportunities. We're not going to try and catch the proverbial falling knife and go all in with our cash reserves just at the first sign of hysterical markets that we've certainly seen over the last little while. But ultimately, we are looking for opportunities at all times, and there are some amazing businesses that are selling for far less today than they were a month or so ago. So we will look at those businesses, but importantly, we need to see, or we need to understand how those businesses are performing in different environments. And our ideal case scenario is a business that can grow its earnings in a variety of different environments, and I'd like to think that we've got a number of those businesses in the portfolio already, and we're on the lookout for more, and we've also got a shopping list of things that we think are interesting at these levels as well.
Rodney, you mentioned earlier that you felt the Australian economy was going really well. It is strong. I mean, it seems to have survived everything that COVID in the last 2 years has thrown at it. So on a local basis, in spite of the issues we've talked about geopolitically, globally, you're quite confident about the Australian economy.
Well, I'm optimistic. I mean, we've had a very good government that in the main have handled the COVID challenges very well. Households have got their household balance sheets in very good shape. There's certainly signs of resumption of normality with businesses open, shops open, and all of those businesses and shops and etc. are going to need people. And with a return to normality, we should expect more normal economic conditions that I suspect will be welcome to everyone and good for everyone. There's obvious pockets of obvious challenges along the way. The risk of runaway inflation is also weighing heavily on investors' minds, and that evidence of that was seen in the recent reporting seasons with some margin erosion due to higher input costs, wages costs, supply chain blockages, etc. Some of those things will definitely be permanent. Some of those things may be temporary, but in the main, the Australian economy seems to be going well, and that will be good for everyone.
Rodney, on that note, which is a pretty buoyant note, I'd like to thank you very much for joining us. Always good to speak to you, and always good to get your commonsensical views of what's happening in the world.
Thanks very much, Chris. I appreciate your time.